Economist Mandla Maleka joins us for more on that. Mandla, thanks so much for your time. Today, a 2.2% contraction in the first quarter. What did you make of that?
It was a shocking number, considering that if you compare it to the last or similar quarters over the last 2 years, they declined. That is now first quarter 16 and first quarter 17. They both declined, but not by as much as this quarter, 2.2% decline.
Yeah.
It's not even a deceleration. It's that an economy failing to grow despite hitting all the right notes. And the right notes we're talking about here really is a positive political environment which led to positive investor sentiments.
Yeah.
So one would have expected at least some kind of a change in the first quarter of this year. Does it really mean that we didn't consume much? Maybe perhaps it says that. Because even on our export side, we may blame the stronger rand that we didn't export much in the first quarter. But interpreted differently, we could have said that we could have then imported more so that we can increase our productive capacity. Even that too didn't take up. So it was a gross fixed capital formation as well.
Yeah. So what does this tell us then? I mean, a contraction had been expected. I think the range of forecasts were between 0.5 and 1%, but 2.2%, as you say, is rather sharp. What happened with the agricultural sector at 24.2%?
From Stats SA, really, they're saying that maybe perhaps it was because of the high base of the previous 2 quarters. Even that too, perhaps, maybe, yes, it was a reason. But if you were to examine it, it's that there was a decline in production of crops.
Yeah.
So if ever there was a decline in production of crops, it talks to whether it was our capacity to export falling, or was our capacity to consume even falling as well? So this is real and very material. But more than that, we know that the primary sector doesn't contribute much really into our GDP. But if these numbers, their decline, have dragged us, our GDP, then it's a big toll. In fact, it messes up with Cyril's Ramaphoria speak. Really doesn't okay well for the current president.
The contraction in mining and manufacturing had also been expected, but if one looked at last week's PMI data, for example, when you looked at business expectations for the next 6 months, they seem to have been positive. So can we still expect a recovery? Have you had to adjust your expectations now, having seen this first quarter number?
No, definitely. I think the expectations going to have to be revised, and even for that matter, revised on the lower side of things. We know that internationally, perhaps the factors that talk to our commodity prices are not really looking that well. The first one being the dollar itself. The stronger the dollar, then the lower will be the prices of our commodities, and it's going to be the lower the revenue from those commodities, and subsequently the lower is the production. So it doesn't look good on that front going forward. So we are hoping that the services sector, as it performed very exceptionally very well, measured either on the production side or rather on the expenditure side.
Yeah.
It really produced some good gains on the services
another
side.
sector that also didn't do too badly was the government side, but we know that we are being asked to rein in on government expenditure. What impact do you think that might have?
Oh no, I mean, on the fiscal space side, we don't have much really by way of government services that we can increase. We know that one of the pressures that the government is looking at is wage negotiations. If they were to surprise on the upside, given the current environment, then this GDP is going to struggle to grow at least to near 2% for the rest of the year. Because if you use the year-on-year figure at 0.8%, you will need about, on average, 2% for the remaining 3 quarters for us to record at least 1.7% on average for the year.
Now, when we look at the expenditure side, of course, tomorrow we've got that hefty, or at least at midnight, the hefty petrol price kicking in. The April tax hike also kicked in. We've got the VAT, all of those things conspiring against a consumer who we were told was starting to get a little bit more confident.
The only relief here really is that the recent cut in interest rates came in very handy, even though it was designed as a cut because of a favorable environment in inflation and a stronger rand.
Yeah.
But subsequently it has come in very handy given the current circumstances. Petrol prices 10 years ago were sitting at half the current price that we're going to experience tomorrow when we wake up at about 15 rands. 10 years ago, we're sitting at about 8 rands.
I don't even remember those days.
So 10 years later, we don't remember. But look at them carefully, those petrol prices. It therefore means if 10 years they were half where they are today, it therefore means maybe they have grown by about 7% over the last 10 years. And we need to look at inflation over the last 10 years. It averaged more or less about 6%. So maybe perhaps a 7% increase in petrol prices over the last 10 years doesn't look big, but materially and nominally from 8 rands or from 7 rands to 15 rands is big. What does it mean to a liter of petrol? For a 60-liter tank, it means about 40, 50 rands more in a petrol tank.
All right, we'll leave it there. Thanks for your time.
Thank you.
Today, economist Mandla Maleka.